Hi, everyone. Welcome to the webinar. I hope you are, excuse me, I hope you are as excited as I am. You can hear from my voice that I am. Just let me know where you're from in the world, please. I find that always interesting. And also, I'm going to put some polls up on the webinar. And that way, I get to know a bit about you, your views, how many trades you place, your risk capital, whether you've traded before or whether you're an expert. Things like that. That'll come up on the poll. So please try and fill those in. But like I said, kick off with just letting me know your name, where you are in the world. Well, your name I'll know because you'll have signed up with that, but where you are in the world. So let's get on with it. I want to cut to the chase, and I'll do that by sharing my screen. So first things first, you're going to need several things in this webinar. You're going to need pen, paper, comfortable chair, turn on any distractions, and get a camera phone because some of the things are proprietary and sensitive, so I'm not going to put them on the replay. Okay, so please have a camera phone so you can take shots of some of the screens. Andrew from Hornchurch, you've been on before. I recognize both the name and the location as well. Hi, Sridhar, and everyone's coming on board now, so lots and lots of names coming up. Ooh, let me just give a shout out to some of those if I can find where it is. Oh, it's on there somewhere. But thank you all, and fantastic. Ravi, I will indeed have a look. So glad you can all see it, and you should also all be able to see my screen. Can you all see that? Just let me know you can see it. Sometimes these things aren't as clear as I'd like, and therefore that sometimes worries me. Okay, so let's kick off. And one of the things that I want to kick off with is, what are we going to talk about? What we're going to talk about is, and what we're going to go through is what I'm going to show you now. Okay, we're going to go through all of this. And what I'm going to do is I'm going to discuss stocks like PayPal. I'm going to discuss Apple. I'm going to discuss currencies like sterling. I'm going to discuss the FTSE. I'm going to discuss indices like the FTSE and the S&P 500, stocks like Amazon, crypto like Bitcoin, Tesla stock, Ethereum, Microsoft. Now, that's just a selection. Actually, I could have picked from any of these. There's a whole bunch you can see on the left I'm scrolling down on, okay, that I could have picked from. And the whole job, for those of you who are beginners, I know I've got a bunch of beginners and I've got a bunch of experts on here, but the whole job, whether you are beginners or experts, and I can see from the poll, most 50% of you are just learning, the rest are doing between 1 to over 5 trades a week. The fundamental point with all of this is we're going to have a process, which I'm going to show you, whereby you know exactly how many instruments to look at, for how long, how you know where to enter, where to exit. There's only 2 decisions ever to be made, which is either we're going to buy, see that button there which says buy, or we're going to sell. All right, and then we're going to close that trade out by doing the reverse. And like making money in anything, whether you're at a market stall or a supermarket, it's buy low, sell high. So these are some of the things we're going to look at, and I'm going to show you those and some of the positions we've got open at the moment. You're going to see some of the recent trades, ones which haven't made money and why, and ones which have made money. And we always put anything that's made money to good fortune, anything that hasn't made money to bad luck. Okay, so I'm going to explain all of that as well. Now, remember, this is, I'll answer your question in a second. This is a trading webinar. So we're going to talk about trading. We're not talking about investing and holding things for 12 months. We're talking about trading. And just in case you don't know what trading is, and let me kick off by just giving you my views on the market at the moment. Okay, just pushing this window back up, he says, which he can't do. Pushing this window back up there. Just looking at the FTSE 100. What I talk about trading is what I mean is, see that green arrow? Anytime you see a green arrow, it means a buy. That was 29th of March. That's 30th of March. That's a sell signal from the 31st of March. Okay, and we're still short the FTSE. So for those who think, well, what's your perspective for the FTSE for the rest of the year? Well, that's a whole different kettle of fish. We're talking, if you're on a 30-minute bar, each one of these bars is 30 minutes. You're talking about looking at things, holding them for a day. So if you've got a day job, it works out well, or 1 hour or 15-minute. Okay, so that's what we're talking about. And the idea is to be in and out quickly, because in a volatile market, Why do people want to trade? Well, they want to be in and out quickly. They don't want to be a hostage to fortune, and it complements their investing, because if they're investing, they know they're in for the long term. If they're trading, they know they can still try and make extra money if the markets are going up and down. Okay, so that's the reason why, and that's just to give you clarity on why we are here. So getting on with it. Quickly, first things first. What this says is basically this is not individual investment advice, because I don't know you individually. So please take a photo of that. Please read it quickly. And like I said, we're here to make money, in the words of David Kite, one of the people who, look, I said this in my webinars before, I'm cheating. See that book? See that bit? I'll just go back on. All right, that is, that's my book, published by the FT, and it's one of my first of my 18 books, and I'm taking the information from there as well as my personal experience. So you've got information today that I'm giving you in this webinar from 10 of the world's leading traders, people like David Kite, he's in the rich list, John Najarian, Bernard Oppetit, Bill Lipschutz, all of those people. All right, just so you know where the information comes from. And let's get back on to the latest trades and what we see and how you should be doing it right now. Okay, here we go. Right, so that's first things first. We're here to make money, which is what David had said to me. And I thought, well, bloody hell, that's pretty important. So make sure you listen into all of those things. Right, I'm going to try and move this forward. Whose insights am I cheating by copying? Well, these were the people that I interviewed when I wanted to be when I wanted to be a trader, leaving practice as a barrister. Okay, so Bernard runs a $2 billion hedge fund now. He used to be head of equity derivatives. Bill, Pat, John, David, and 5 others. I won't go into all of these names. Why am I looking at this? Well, if you want to be good at something, you better pick the best people in the world at it. So they were all in that book. I'm going to give you lots of freebies in this webinar, as I promised on the email. Lots of cheat sheets, videos, and articles, and all the rest of it. So you don't need to buy the book. All right? I don't need the royalties. I hardly get any anyway. I don't need the royalties. What I'm going to give you is all of that information as the webinar progresses as well. So that's the sources of information. And these are professionals. So please remember, all trading is risky, okay? Follow me on LinkedIn. If you haven't already, you'll get to see a whole load of other stuff and articles and videos, all completely for free, about trading, what you should be doing, what you shouldn't be doing, taking information and advice from the best and leading people in the world at the job, okay? Now, my reasons for trading are different to yours. When you first start out, you're bottom of the pyramid, you're just doing it for the money. You're doing it for the funds. But let me tell you why I think it's worth persevering with. For me, it's also meant fun, freedom, and allowed me to participate in philanthropy. That's later on. That's the long term. That's what gets you through the times when you're not making money, okay? So that's just to let you know my overall reasons. Rob, can I comment on Microsoft? I will indeed. I'll have a look in a second. Deepak, is this webinar for trading, investing, or both? Deepak, it's for trading. It is for trading. Okay. Now, big warning. Look, about 34% of people make money, 66% lose money. Now, this webinar is for you whether you CFD trade, spread bet, use futures, options, or cash. You just trade using cash. Okay. Whatever instruments you're using, and we'll talk about instruments in a second, it's all about buying low, selling high. So let's take Microsoft as an example, or the FTSE. It's about buying at one price, selling at a high. Now, you could do that through an option. You could do it through a CFD, through a spread bet, through a futures contract. Could be all sorts of ways. How you do it in one sense almost doesn't matter, and that's more a technical issue. It's buying low, knowing where to buy and when to sell. 66% of retail clients, you'll have seen these warnings in most brokerages, lose money when they're trading. Okay, let's say 66%. So that means 34% make money. My job is to get you into the 34%. Is it easy? No. Well, let me put it this way. Somebody once put it really well to me, which is, it is the hardest easy money you will ever make, or it's the easiest hard money you'll ever make. Whichever way you look at it, that's what it will be. Okay, now we're going to use data in this. We're going to use data like this. This is from a brokerage, and I'm going to try and give you as much of an inside edge as possible. We're going to pick instruments. They might be foreign exchange. You might not want foreign exchange. Fine, don't do Forex then. There might be stocks. There might be indices. There might be crypto. There might be commodities. I don't care what I buy and sell. Like a supermarket, I don't care. As long as I'm making a profit, I don't care whether it's beans or whether it's, I don't know, vegetables. What I do care about is, and I do know, is that there are certain instruments where I've got a greater likelihood of making a profit than a loss. This is from brokers who monitored their retail clients. Notice how retail clients overall were losing money, right? They're losing money, almost 2 to 1. It's a lucrative business being a broker, being the house, okay? Paul said, I always thought 90% or more lost. Paul, you thought wrong. It used to be the case until the FCA required brokers to put the number of losing clients on the front page of their websites. Once that happened, the brokers were competing with each other to make sure they weren't having too many clients losing. So the numbers started dropping. It went from 90% lose money to 85 to 80 to 75 to 70. Now currently it's roughly averaging about 66% if it's an FCA regulated broker. If it's not, if it's Cypriot regulated, then about 90% are losing money, because the Cypriot brokers are ripping you off. Okay, but FCA regulated brokers, the figures have gone down. So in a way, you're right, Paul, but I mean, think about it. Obviously, it's going to happen like that. If the FCA, the regulator, makes you display how many of your clients are losing money, you're going to think to yourself, shit, you know what? People like Alpesh are going to start comparing brokers based on what percentage, and then we better start moving down the line a bit and having, 66%. So they seem to have settled on about that. It's weird how they've all settled on 66-ish%. You know they're not allowed to collude, don't you? Price fixing is a criminal offense. Okay. So I'm sure the CEOs of these brokers don't meet up and say, we're going to fix it at 66. It's just that they keep an eye on what their competitors are doing, and they know better not go into a price war with them. Anyway, given that 2 to 1 are your losses to your profits if you're a retail client, according to this data, let's try and pick things which give us a bit of an edge. Okay, so we're going to try and pick instruments which give us a bit of an edge. It might be, for instance, I don't know, US dollar, Canadian dollar, a major versus a minor currency like that, or Australian dollar, Japanese yen. Once again, a major versus a minor currency. Okay, I certainly don't really want to be doing euro dollar. It's bloody hard to try and make money on euro dollar. And I don't really want to be doing sterling yen. Okay, it's hard. I don't want to be doing dollar yen. It's hard on the whole, and those are all, there's only 4 major currencies. We'll talk about other things as well, but I'm going to give you that edge, okay, is what my point with the webinar is. So, like I said, we're going to go through a whole bunch of instruments. Today, I showed you some of them a moment ago. For those of you who've joined a little bit late, for those of you who've joined a little bit late, these are the instruments we'll go through. Okay, we're going to go through stocks like PayPal and Apple. We're going to go through indices like FTSE. And oh, is that just a short now? Yeah. Okay, so we're short the S&P 500. That's live as near as damn it, because you can see it. There's the arrow, which tells us to go short, and there's the price drop. So we'll keep an eye on that one in particular, because it's happened on the webinar. Sometimes you get a signal on the webinar. It happens on the webinar. My team will be monitoring this, and they'll know to have placed that. So let's see if you guys are lucky for me and we make money during the course of the webinar on being short the S&P 500. All right, we'll see. We'll see what happens on that one. He says, trying to move the bloody thing out of the way. There we go. Okay, now, all trading, when you do it every 100 trades, if you're doing it right, the good and the bad news is this is what your P&L, your profit and loss, will look like. 20% of your trades will give rise to 80% of your profits. Write that down. 20% of your trades will give rise to 80% of your profits. I know we want every trade to be winning. It doesn't happen like that. We don't have a crystal ball. We are not going to get 10 out of 10 winning trades. We're not going to get 9 out of 10. We're not going to get 8 out of 10. Unless, a bit like tossing a coin, you get a string of heads. Well, that doesn't mean that the coin is biased or you're an amazing coin tosser. It just means you got a string of heads. That's all. Don't read too much into it. All right? What's actually going to happen in trading is this is what it looks like. This is exactly what the number of trades for any successful billionaire hedge fund looks like, whether it's John Najarian, whether it is Bill Lipschutz, who was global head of foreign exchange trading at Salomons, the world's largest Forex bank, and he was global head of Forex trading, and he was in my book, Mind of a Trader, and he was one of my mentors, the first person I met who started teaching me trading, and we published it in the book. Or whether it's a David Kite or whoever, it's gonna look like this. Now, that's good and bad news. The bad news is every trade isn't winning, and every trade isn't a big winning trade. The good news is that's what billionaires look like. So there's good and bad news. Notice a couple of things. Yes, you have small losses. I wish we could avoid them. Yes, you have small wins because the market was profitable initially, then it turns against you. It happens. Okay, the small losses and the small wins cancel each other out. It's a hell of a lot of hard work. 80% of your effort amounts to nothing. 80% of your effort amounts to nothing. Well, don't be too disappointed. It's probably what, I don't know, life is like, or marriage. I don't know. 80% of your effort will amount to nothing. 20% will turn out to be big wins. So how do we make sure we get those? And notice this is the most important thing, the difference between private investors and professionals. And I'm going to get you in the professional camp, the ones who are profitable, the 34% who are profitable and away from the 66% who are losers. They have big losses, the losers. We've got to make sure you don't have big losses. How do we do that? Well, we're going to engineer the system in a way where you don't have big losses. We're just going to do it that way. Okay, so you can't have big losses, right? So that's what we're going to do. That's also what this webinar is about. Right now, a few lies to get out of the way. Lie, you make a few big bets. That's how you get rich. No, when I was interviewing them, can you see that? When I was interviewing them, it's Financial Times published, so we know it's bloody authoritative, and it's interviews with them. Okay, so it's their words. When I was interviewing them, I was expecting them to say we got stupidly rich, Alpesh, by making a few big bets. They didn't. Not one of them said that. What they said is what I've just said to you. We're going to have out of 100 trades, 20 which turn out in the end being good and no big losses. Right? So how is that? How does that work? I'll tell you. Another big lie, the broker's on your side. No, they're not. When they start telling you about all these wonderful platforms they've got and everything else, it's just a marketing gimmick to get you to use them and like them and blah, blah, blah. Okay? That S&P is doing nicely. It's falling even more. Remember, shorting or selling high, let's say selling at 100 and buying at 90 is the same as buying at 90 and selling at 100. Still a 10-point difference and you make the profit. And shorting is what the S&P 500 are doing at the moment. Lie, specialize. People say, oh, I only do oil and I only do gold. Look, it doesn't matter where you make your money. Think of yourself as a supermarket. And the reason for that is by diversifying the number of products you're looking at, you've always got an opportunity to take some money off the table every day. Because guess what? Today, the S&P might not give you money, but something else might. Okay. Dibak asked, didn't Soros make a big bet? No, not compared to the total capital he had under management, and he added to his winner. So here's an interesting thing. Soros in 1992, people said he broke the Bank of England, he made $1 billion. He didn't make a big bet for two reasons. The return was big, you're right. His fund had probably about 100 billion under management, okay, back then. So he made 1% return. Fantastic. Which is fantastic. I wish I was him, by the way. But the other thing is, did he use, how much of his capital did he use? He was adding, as sterling fell, he was using the profits he had as collateral to buy more futures contracts to sell sterling further short. So he wasn't actually risking his capital, he was risking profits. So was it a big bet? No. And I'm going to show you exactly that approach in a second, and we'll get back to Soros. The thing is, and you remind me of an important point, Deepak, the things you think you know, and Paul mentioned it earlier where he said, oh, don't 90% lose money. The things you think you know are not so. And I'll show you the data and the evidence for that in a second. And actually a quote from Soros, because we're going to use Soros quite a bit because he's well known. And he's bloody good at what he does. And I don't want to sort of detract from anything from what I've said to say that I wish I was him, you know, in that world. Lie that you need to watch the markets for all the time. Actually not true. And I'll tell you why. You know, all these people saying, oh, trading academy, trading university, trading school. Okay, and they say, oh, get lots of screens. You can if you want. Amazon sell them for £100. It'll make you feel more of a man. Great. Or woman. Women tend to be more sensible in my experience. But anyway, you can, but I don't recommend it, right? You don't have to watch the screens all the time. What we found, chairman of the Chicago Board of Trade told me this. He said what he found is the longer the traders stayed on the floor trading, the more likely they were to do low-quality trades. They either did low-quality trades because they'd won and thought they were untouchable, or out of boredom, or because they lost and they revenge traded. So, yeah, I wish spending more time in front of the screen made you richer. I'd just have a load of people staring at the screen all day long. But sadly, it doesn't work like that. We're going to have a process which gives us our return on time invested. That's the critical factor. I wrote a column in the Financial Times many moons ago where I calculated that most people would be better off working at McDonald's than trading. So we've got to make sure through the business plan I'm going to show you, is any of this worth it? Won't necessarily be worth it today. It wasn't worth it for me when, as a penniless student, I was starting to trade and learn how to trade, but I wasn't thinking about that. I was thinking, well, if I can learn the skills and I can make 500 a month, then surely I can make 1,000. If I can make 1,000, I can make 2. If I can make 2, I can make 4. Because by hook or by crook, I'll get hold of the capital, whether from friends or family or whatever method, I'll get hold of the capital. So initially, it might not be worth your time. But if you learn the skill, then you're looking to the full future, and that's what we're going to look at a business plan for it. Now, we've got a lot of choice. When I'm going to look at all of this, you'd go mental. Life's not worth it. There is a limit to money, as we all know. Life's not worth it if you're sitting in front of a computer screen all day long, getting hemorrhoids. Okay, it's not worth it. What we've got to do is pick a certain number of instruments, ones which are easier to trade based on the data. Easier is a relative term. And then focus on those. How much time? What are we looking for? Place the trade. Automate as much as possible. You know we live in a world of automate as much as possible. So tell the broker, buy at this point, sell at this. Boom. You've only got 2 decisions to make. You, me, and Deepak George Soros. 2 decisions to make when we see prices of anything, which is when to buy, when to sell. Those are the only 2 decisions. When to buy, when to sell. Okay. Like I said, watch to the end. You're going to get all the information I'm talking about, videos, articles, all for free. Some of my trading and investment books to download completely for free as well. And access to my Telegram channel for free as well. This is it. This is all it's about. This is what we're looking for. Okay. Right here, right now. The difference between you and Soros, and I'm glad you mentioned Soros, Deepak, because I'm going to use him because people have heard of him. I'm going to use him as an example throughout this. The difference between you and him, you should see the same prices he does, pretty much. Okay, his commissions might be a bit lower, spreads might be a bit tighter because he uses a prime broker institution straight into the market, but that's a minimal advantage as far as you're concerned. When to buy, when to sell. So the difference should only be the amount of capital you have. Look at those 2 trades. 4 traders did exactly the same trade, hypothetically. Okay, they did all the same trade, assume they did. Soros, he's on the screen, Deepak. Trader 4 makes $1 billion. Why? Because he got more capital. That should be the only difference. It shouldn't be anything else. So let's try and remove all other obstacles and try and level the playing field. And we're going to try and pick a trading approach, a trading strategy, which is suitable for private investors. So we're going to look at momentum or trend following. We're not going to look at some kind of complicated arbitrage or some political analysis or economic analysis. Have you got 100 analysts in your back room? Probably not. So let's not go down that route. Have you got a supercomputer to do ultra fast algo trading? No, probably not. So let's not go down that route. Let's go for what of the many myriads of trading approaches are suitable for you, which is what I was told. I was told, you know, why would I be told how to go and do merger arbitrage if I don't have the capability? Right? Oh, there he is, Deepak. It's not whether you're right or wrong, but how much you make when you're right. Like I said, we might only be right 50% of the time, but if we can make more when we're right by adding to our winners, and write this down, winners add to winners, losers add to losers. We'll come back to that. And how much you make, how much you lose when you're wrong. One thing we've got to do is we don't have any big losses. It's as simple as that. Okay? So you're going to have to explain to your spouse or your partner or your parents that you want to be trading as a side gig, as an entrepreneurial side venture. You don't want that franchise. You don't want to work in the shop. You want to trade on the side. Okay, well, if you're going to do that, you're going to have to explain to them why you're not a gambler. I've used the 90% figure there, Paul. I've used the 90% number there, the older number on that one. Well, the gamblers, unlike the traders, the gamblers will trade big money relative to capital. So if they lose, they could lose a lot. That's stupid. That's gambling. That's the definition of gambling. That's stupid. Why would you do that? Okay. I actually thought that's what they did, by the way, before I met them. Before I met the leading traders, I actually thought they just traded big. Little did I realize that they didn't trade a big amount of their capital, because if they did, they'd get, well, first of all, as a hedge fund manager, we're not allowed. We'd be breaking our covenants to our LPs, our limited partners, our investors. Our investors are pension funds like Aegon. So if we started investing a big amount of our capital, it'd just raise a red flag. But also, most people don't realize this. So our funds initially, when we launched, were domiciled in the Cayman Islands. The Cayman Monetary Authority, CMA, would, or I think actually it's CIMA, the Cayman Monetary Authority, Cayman Islands Monetary Authority, would tell us we're in breach. Okay, so there's a lot of fail-safe. Then month end, our administrators would, and our accountants would, and our auditors a bit further down the line. There's so many red flags if we did any of that. Okay, so that's one thing. We don't look. Gamblers look to do a few big trades. They go all in, like in poker. They try and step in front of market reaction by guessing the news. We're not going to be doing that. You might think, oh, that's the way you want to trade. That's up to you. Then go to Ladbrokes. They add to losing positions. Now, don't take my word for it. Look, on anything I'm telling you, you don't have to take my word for it. I'm just copying what the leading traders, and I didn't rely on one, I relied on play 10 of them, plus a whole bunch of others that I hadn't met, but knew what they were doing. And then rely on what it is that Aspect Capital does, Winton does, AHL does, all of these hedge funds that we want to be like, Brevin Howard does. What is it that they were doing? Okay, so we're not looking to step in front of the news. Add to a losing position? Don't do that. Start big, take small profits? No. If anything, start small, add to a profitable position, right? So it's the exact opposite of what a gambler does, and I'll show you that in a second. Gamblers will have no stop losses, or the stop loss will be so far away to be meaningless. And a gambler, if they have 3 losing trades, and you could throw tails 3 times in a row, okay, could have a good strategy, good system, but you still throw 3 tails, okay, they will be down between 10 to 50%. You do not want to be down 10 to 50% if you lose 3 times in a row, right? A trader doesn't do any of those things. Small positions relative to capital, a lot of small trades, follows trends in the market. So we're not trying to step in front of the market. We're trying to see where the market's going and just ride those coattails. It's a lot easier to follow big money than try and guess where big money is going to go instead. They don't add to losing positions because only losers do that. They start small and add, and the other bits you can read. Okay, so I'm going to put you into 3 categories. All of you on here, I'm going to put you into 3 categories. Okay. Beginner, intermediate, advanced. Now, Dipax asks, what about Ukraine war? Okay, so let me just explain what this webinar is about, right? Let's have a look at the FTSE. Now, you can see that was the short trade on the 31st of March, and we're short it at the moment, okay? Did the Ukraine war have an impact in the last 12 hours on that trade? I don't know, maybe it did. Maybe it did. We're talking about trading. We're not talking about investing. We're talking about trading. Trading is holding things for a short period of time because you don't want to be in the market for too long. You want to take the trend and you want to get the hell out of there. Let's take Amazon. Okay, so Amazon we've been short on for 2 days. Was that the Ukraine war in there? I don't know, because we're trend following. So we're not trying to guess the news. I literally said we're not trying to guess the news. We're not trying to guess the news. What we're trying to do is follow the trend. What did cause that trend? I don't know. Maybe it was the Ukraine war. Maybe it was Amazon sales. I don't care. I don't know. What I know is that if I buy low, sell high, that's what's important. So how do I know that that was going to go up? Did I know it was going to be the Ukraine war on the 24th of March or some other thing? Maybe I just had an itchy toe, and that's a really good signal. No, it wasn't any of those things. It was that we looked for trends and momentum. So how do we do that? I'll come to that in a second. And we got in and got out. So in other words, we're not looking for causes. We're not trying to understand the market. All we're trying to do is buy low, sell high. Why it's going to go up is going to be based on momentum. And whether that momentum is caused by noise, whether it's caused by war, inflation, or a million other possible things it could be, we're not going to try and guess that for obvious reasons. We'd have to have a supercomputer in our brain to be able to do it. We're going to ride the coattails of somebody else moving the market. So it's a pretty simple concept. In fact, it's too simple for most people because what they think they should do is have a master's degree in economics from the #1 university in the world. By coincidence, I have that. It's utterly useless for trading. Trading is buying low, sell high. It's too simple for most people to grasp. What they'll do is they'll say, no, but what made it move? Well, I'll tell you what, and this is really important to know as well. And the reason people are confused about this is when I'm on TV on the BBC talking about price of oil, as I was here, okay, what will happen is I'll be talking about all sorts of reasons why oil would have gone up. In actual fact, I'll have looked to see where the momentum is and which direction it's going in and what we're using on our algos, and that'll be it. That'll be the actual moves. Now, I can ex post facto rationalize it to death as to why, what, when, how. None of that actually, is it true? Isn't it? All that's true is, did I make a profit? Okay, so let's admit, I'm going to put you into 3 categories. You can put yourself into 3 categories: beginner, intermediate, advanced. Now, let's imagine you got something like this, and you'll see as we go through this webinar that a lot of the positions I'm going to show you are like this. I think I just showed you the Amazon one, which, as I said, what are we on Amazon at the moment? We're just long. There you go. Okay. But it was short before that, and it was long for ages before that. All right. So given that that's the case, given that that's the case, right, we get an entry, we get a green arrow. Now I'll come to entries. How do you know that? How do you know? If you're a beginner, what you should probably do, and it's the easiest thing for you to do, is at point B, you have a stop loss. At point C, the dotted line, right, which is just a mirror reflection of the distance from A to B, okay, is A to C. They're the same distance, all right, equidistance. Point C is where you take your profit or limit order. So if you get at point A, whatever strategy you have, and I'll give you mine in this webinar, but if you have a strategy which tells you to buy, you'd have a fixed stop loss and a fixed take profit, because you're a beginner and you want to keep life simple. Okay, how do you set your stop loss? Well, you might say, well, there's two things hedge funds do which they all had in common when we met them. And we didn't know, first of all, whether they'd use stop losses at all. So the first thing is you got to use a stop loss. The second thing they had in common is they never added to losing positions when they were trading. Investments are different, but trading, which surprised us. Look, I'm only going by what I learned and saw and what's worked for us. Okay, losers add to losers said, I've forgotten his name now. It was one of the ones I didn't interview, John Paulson. Okay, he said losers add, I think it was John Paulson. Anyway, it said losers add to losers. So that was another important thing. The other two most important things were volatility-based stop loss and volatility-based position sizing. In other words, VPL and VPS. VPL, volatility-based position sizing, and volatility-based stop loss, VSL rather. VPL something completely different. VSL, volatility-based stop loss, and volatility-based position sizing. Right? So A to B. What does that mean? That means the more volatile the market, see those bars, each one of those bars representing whether it's 15 minutes, 1 hour, 1 day, and I'll tell you which time frames we think work best, whichever. John Paul Tudor, that's right, John. Thanks, David. As I get older, I'm getting more like yeah, I forgot the name of the bloody person as well. Honestly, my brain's going. That's volatility. That's noise. Okay, how much it moves in a day or a period, an hour or 15 minutes or whatever. And we don't want to be stopped out by noise, obviously. Okay, that's not the point of a stop loss, to be stopped out by noise, because then you'd always be stopped out. Noise just happens. So you want to be outside noise, but you don't want to be so far away that it's meaningless. So what you might do is you might say, well, we'll work out what that range is from top to bottom, and we'll put this maybe somewhere between 2 to 3 times the distance away. Put another way, and you can Google this. You can keep it as simple as 2.75 ATR, average true range, if you wish. Simple, it's the principle that matters. You might do it by eye. Okay, you might have a computer program which just tells you, as we do, SL, there, it tells us where it should be. It's based on the volatility of the instruments. Why that's so important? The reason it's important is because in a more volatile instrument or more volatile time in the markets for that instrument, like the Ukraine war, you will naturally put the stop loss further away. It's not because you're guessing whether or not the Ukraine war has an impact on your investment or trades. It's not that. It's not relying on your brain. It's relying on the fact that you can actually see the bloody numbers. There, the range. The range is bigger. You put it further away. So 2.75 times ATR is fine, or just, sufficient distance that it's between 2 and 3 times the distance away. So there's your stop loss. Simple as that. All right. And there's your take profit or limit order. And your brokers will explain, okay, I've got this. I want to buy here. How do I do that? How do I put a stop loss here? They'll tell you. How do I put a take profit there? They'll tell you. And then you leave and walk away. The ones who keep looking at it every minute on their phone are going to have a low return on time invested, and they're going to mess it up. They're going to interfere with it. All right. So that's that. Now, let's say you're intermediate instead. Let's say you are an intermediate person. Okay. I'll put another poll up. If you're an intermediate person in this, what are you going to do? Well, what I suggest you do there is you don't have a take profit. And this is important. Why? All those people who talk about risk reward ratios, bullshit. They've never traded. They're not hedge fund managers. They haven't got a clue what they're talking about. And I'll tell you why. If you find oil in your back garden, do you put a cap on it? Obviously not. You don't say to yourself, well, it's my reward. I'm going to cap it no matter what. No. So if you're intermediate, what you do is you take the cap off. All right. So at point C, you just ignore C for now. You'll have point A where you've entered, and B becomes a trailing, not dynamic, but stepped stop loss. What that means is when the price moves from A to C, when it steps up, this only at that point steps up from B to A. So it's not following the price up point for point, but only in steps. Okay? Simple, straightforward. Why are steps better than dynamic? Well, it makes a marginal difference, but sufficient. I think it's an important difference. And that's it. Now, what does that do? Well, you've still got your volatility-based stop loss. Oh, by the way, question that I forgot to answer, which you should have asked me, which is, wait a minute, if it's more volatile and the stop loss is further away, surely you're losing more money potentially. No, because volatility-based position sizing means you'd reduce your position size accordingly so you don't lose more money. Well, wait a minute, what proportion then of your overall capital should you lose or risk? We'll come to that in the business plan because that belongs in the business plan stage of the webinar. So we'll come to that, right? So what did the wealthy people do? What did the super rich do? I'm giving a TEDx talk in July, and I'm going to be talking about what I'm talking about now, essentially. So what is it that the super rich hedge fund managers, the most successful ones, were doing? Well, as you'd expect, a lot of them had many traits in common. One of them being volatility-based stop loss, volatility-based position sizing. They never added to their losers. And if they were advanced, they did everything that I've just said, trailing step stop loss, but they added to their winning position at point C, which is what Soros did. So you start small just in case you get it wrong and the price could fall. And then when the price goes up to point C and you've got some profits in your pocket, you add another position. And when it goes up again, you add another. Now, he pyramided. You could call it a pyramid, a skyscraper, or an inverted pyramid, depending on whether you double up or you only add a 50% size position again at point C, or whatever. That's advanced. So I'm not going to go into too much detail of that, but that's how the real money's made. It's adding to winners. Only 20% of the time will you get the opportunity to do that, and that'll give rise to 80% of your profits. So the good news is 20% of the time that will happen, and you make a killing, and that's where 80% of your profits come from. The bad news is that'll only happen 20% of the time. Yeah, so, you know, at this point you might say, screw that, nah, I want something which works 100% of the time. It's called a crystal ball or a time machine. I'm not in the business of time machines or crystal balls. Sorry to have wasted your time. Selma, this is your process. Stop loss, I've put stop less, excuse me. Entry, we're going to come to. Limit order is take profit if you're a beginner. Momentum, that's the kind of trading we're doing. How much money to put in, that's the business plan. Adding to winners, I've just shown you. So we've covered about half the webinar already, okay? The difference between you and me and professional hedge fund managers is this. Prices can only do one of four things. The difference is, and by the way, whatever we're looking at, okay, I'm going to look at PayPal. Right, PayPal was still short on, but we were long 2 days ago. Now, the reason I'm looking at this, and this is live and what we've got, now I've got a long-term holding in PayPal. So the fact that I'm short on PayPal now works really well for me. Why? Because it allows me to make a short-term profit over the last 2 days, which pays for my long-term holdings, which if you know long-term holding in PayPal hasn't done too well over the last year. So am I worried about my long-term investment? No, because fundamentally it's a sound company and that's a long-term investment. But I'm also not worried because every time I short it, I think this is just paying for the long-term position anyway, and that's going to become free. It's going to like an unencumbered house. I'm going to have paid it off just from some of the trades, which is why trading and investing are interrelated. Anyway, that's the short position. Now, what do I want to say about this? One of the other benefits of trading is this. 1 minute you were long, 1 minute you were short. Now, that happened in the space of 3 days. What the hell happened to PayPal in 3 days? Was there some PayPal-specific news? No. Was it to do with Ukraine? Was it to do with consumer price index, unemployment figures, Federal Reserve minutes? Did you read them all? Did you read? Yeah, I take it you read the Federal Reserve minutes, didn't you? No, you didn't? Oh, okay. So that's obviously what, I don't know if that's what happened. I don't care. That's the point of it. One is, A, we want to be in a position just to be as stupid as saying, right, we've got some momentum, let's buy. Got some on the other side, let's sell. Look at these trades. That went nowhere. That was actually a small loss. That went nowhere. Hang on, Alpesh. That's a bit too honest. You had a. Let's call trades which went nowhere losing trades. You had a losing trade. Big win. Hell yeah. Guess what paid for some of the times where markets sometimes, wrong foot you. We get wrong footed more often than we're right footed. But when we're right footed, we make more than when we're wrong footed. And we're not special or unusual in that regard. And that's what it is. And the reason I want you to know this is if you try and do something differently, you're just going to waste a lot of time and effort and energy. And the great thing about trading is I didn't need to know why that went up. I didn't need to know why that went down. But given that it went up, I made money. Given that it went down, we made money, right? We don't need to understand global macroeconomics. Now, this one, actually, I'm not going to show you that. I don't think I need to show you that one because I've sort of explained it. So I'm going to go into this instead. Let's say you had a simple, oversimple business plan. Okay. Kevin said power's gone down in TN27. Yes, I'll make sure they sent a replay. 25 trades per month. Let's say at most you're losing 1% of your capital on any one trade. So if a stop loss gets hit straight from entry, only 1% of your capital is lost. And we're going to start off with 0 capital on a demo account first. Anybody who ever tells you don't start on a demo account, start with £3 a point or £1 a point, they're trying to scam you. They're getting kickbacks from a broker because guaranteed they're going to say in the same breath, and then you might want to use this broker of ours. Right, don't. It's real money you're dealing with. It's your hard-earned money. It's not my money. It's your money. Therefore, demo account, right? And only when you're consistently profitable do you switch to live money. And when you switch to live money, make sure it's as little as 7 or 8 cents or 8 pence a point, whether it's spread bets, CFDs, trading with cash or whatever. Only at that point, and always risk capital. Now, let's say you lose 1% on one. Let's say you would do 15 trades. Now you're going to add to your winners. So on average, let's just assume it's a bit over optimistic. Okay. Let's say you make 2% on each of the winning trades. So double what you can lose, right? Just because we're adding to winners. Just take these assumptions for now. All right. Indulge me. And you have 10 losing trades. Okay. So we're not making out of 25. We're not making 20 winning trades. We're 15 to 10. Okay. Fairly reasonable, but don't worry. We'll dial these assumptions down. Then you'll have made 20% because 30 minus 10. It's not a bank account. You're not guaranteed to make that every month. Okay. That's what will have happened. Okay. Now, if you have £2,000, then that means you will have made £400 and you've got the skills. We've got to learn the skills. I mean, that's the big if. It's all very well giving numbers and accounts, but bloody hell, somebody's got to actually do this. Now, let's get conservative or pessimistic. All right. Let's say you only made half that. So £200 in a month. Fair enough? Well, you'd be making 100% per annum. Let's get pessimistic again and say you made only half of that yet again. That's 50% in a year. Well, so I asked Bill, obviously, when he first presented me with all these numbers. So I asked him, I said, Bill, as a private investor, what should I be actually trying to make? Don't take my word for it. No point me telling you what it is. He said 100%. As a private investor. You're not going to be able to do that as an institution because as an institution, you're going to have all sorts of restrictions on you. But as a private investor, he said 100. That's his words, and they're published in there. Okay. And I said, how the hell? And he said, well, let's look at some of the numbers. So let's work backwards. And Bill was global head of Forex at Salomons, remember? So let's look at some of these numbers and work through that. By the way, can I write at the end? And I always ask your permission for this in my webinars. Can I tell you some technology my hedge fund spun out? It's right at the end. You don't have to stay. The reason I ask your permission is sometimes people say, oh, you give us some great information about stop losses, volatility-based stop loss, position sizing, the approach, the business plan, blah, 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 blah. But you ruined our life by talking about yourself for the last 10 minutes or more. So I'm going to ask that, okay, if I may. Now, pay attention to this bit. This is the most important bit. We're going to talk entries now and business plan. It's where the money's made. This is the most important bit. Everything up till now was the setup to explain the most important bit, but it was necessary. First things, how do you know when to enter? Well, we're going to use the same strategies firms like AHL do. How do you know their strategies? Well, other than interviewing the bloody people, okay, they're public. They're not actually, strategies are not a scarce resource. What's the scarce resource in life? Do you think it's intelligence? Nope. If you want strategies on trading, go to Oxford University Maths Department or Computational Science Department, and you'll find loads of people who will give you strategies for the markets. Capital is the scarce resource in life. Money is the scarce resource in everything. You don't need me. You don't need to be on this webinar to be told that. Okay. So strategies, I've got to give my strategies. When I've got investors in my hedge fund, okay, I've got to give them the strategies. We've got ultra high net worth and family offices. We've got founders of Originally, when I set up with the founders of Cobra Beer and founder of New Look, I had to explain to them what the strategy is. Now, they might have looked at me blank-faced. I am a glorified plumber for them. My job is, you might say, well, why didn't they just do it themselves? They've got other things to do. And it takes a little bit of skill, like driving. I'm their chauffeur, basically. All right, so let's not, I don't want you to think, oh, wow. No, I'm just like any other service provider. I'm just hired to make rich people richer or, be their chauffeur. That's what it is. They don't want to drive themselves. They know how to drive. All right. These are some of the people who are copying. They all do exactly the same strategy we're talking about, which is trend following, getting in, getting out at the start and the end of a trend. They don't do merger arbitrage. They don't do options, and they might add those on, but they generally don't do options. Okay, Paul Tudor Jones, there he is. John W. Henry owns Liverpool Football Club. David Harding is now Sir David Harding in the New Year's Honours list. He owns Winton Capital, which is based out of Hammersmith. He was an academic. He wasn't paid much as an academic. He's now worth more than 690 million. And Man Group is British as well. Okay, so that's who we're copying. We're also copying the information we got from academia, because I don't just want to pick a whole load of people and take their subjective interpretation of what they're doing and then base my life on it. I also want to make sure, okay, have we got any other information independent of them as well? All right, so there we are. This is actually a slide from Winton Capital, the multi-billion-dollar hedge fund out of Hammersmith. And don't tell them I've stolen this slide. I've stolen this slide. Okay, this is what we're doing. We're not trying to get in too early. For those of you who want to get in early, sorry, this is not the webinar for you. You're never going to make money doing it. Those of you who are trying to bottom fish, who have been told, oh, if you do the Fourier transformation like this and the Fibonacci like that and the Elliott wave like this, and then stand on your head, turn around 3 times and say, Macbeth, guess what happens? You get the exact bottom of the market. No, you need to go spend more time on TikTok probably. Okay, we're doing this, which is what Winton does, right? That's all it is. And he was explaining this to his investors. It's all they do. They have to explain it. Nobody's going to give money to somebody. Deepak said a well-dressed plumber. My friend, plumbers are better dressed than I am. Have you seen how much they earn? Okay. So here we go. Here we go. That's what we're trying to do with this. All right. And you might think, Alpesh, no, I think you're wrong. That's surely not how they make money. They're the cleverest people on the planet. Surely they're just really, really intelligent. They are really intelligent. They're intelligent enough to know, like all geniuses, we've got to simplify this. Actually, the bigger problem they have is one we don't need to worry about, which is how do you actually trade this in billions across multiple assets? You don't have that problem. Sadly, I don't have that problem. I wish I had that problem to solve. Now, that's where you need clever IT and lots of hugely intelligent people to work out how do you make sure you get the execution when you're trying to do $1 billion trade. That's a different, we don't have that problem. Okay. We just want to ride the trend they've created, or whoever's created it, whether Ukraine's created it or a computer program or Winton. I don't know what creates trends. Whatever's created it, we want to ride it so we can buy low, sell high. That is it. That's one of their slides. Now, it annoys me as well. I'll tell you why it annoys me. Think of it. I qualified as a barrister. I have a master's degree in philosophy, politics, economics. I also have a degree in law. And I'm a freaking supermarket guy. I'm buying low, selling high. That's pretty bloody worthless. Thankfully, my parents don't understand what the hell I do. But if they knew I was like basically a market stall person, they might be a bit disappointed. All that education. Okay? So the point is, I'm afraid it is that simple. It is that stupidly simple. Okay, and we're not trying to beat the computers. I'm not trying to say, hey, listen, I'm so clever, I can beat computers. We're actually just trying to ride the same trend they've got. Now, this is what a typical month might look like. So we looked at December and January, okay? We looked at the end of December up to the end of January. So it's 1 month, basically January, all right? And I took FTSE 100, just as an example. Neither good nor bad. And you can see the green arrow was where we saw some momentum, just like you did in that stylized chart from Winton. And buy, sell, buy. That's a loss. That was a losing trade. If you don't like losing, don't go in the markets, right? That was a small win. Look at all that time you had to spend trying to find it and then go. By the way, I'm going to show you how we save time in a second. That was a sell. That was a buy. That was a losing trade, losing trade. That should be a losing trade as well. That was a losing trade. Win. Now, Is that good? Is that bad? Well, I don't know. What? 1, 2, 3, 4, 5, 6 wins and 1, 2, 3, 4 losses. Well, there you go. 60%, 40, 60, 40. Okay. But it could have been 50-50. And as long as the losses were small, I don't mind if it was 40-60. Doesn't matter. That's reality. Now you might say, no, Alpesh. No, for somebody else on the FTSE 100, the prices would have been different. No, they wouldn't. Oh, no, Alpesh. By nature of black magic, we would have got in lower and we would have exited a lot higher, somewhere up here, which nobody else in the world could have done because those prices didn't exist. Do you see? I'm a prisoner of what the market gives me. Did I know it was going to go up or down? No. Was I clever enough to work out whether it was up or down? No. It's not what I was doing at all. All I was trying to do was buy low, sell high. So I've probably removed the illusion that I've got any IQ at all in front of you. Warren Buffett's put it this way very often. He said, look, if you're going to go into finance, you really don't need a high IQ. In fact, most of it would be wasted. If you've got anything more than 100 IQ, average IQ, you probably just might as well sell the rest of it over 100 because you don't need it. I won't tell you what mine is because it is embarrassingly unneeded, so much of it. Now, that chap, not Warren Buffett, he was chairman of Salomons when Bill Lipschutz was global head of foreign exchange. And so I'm going to give you the strategy he taught me. We've got 10 strategies in our hedge fund. I'm going to give you the one that he taught me. Why am I going to give it to you? Well, let me know if you're going to put me out of business because I'd like to know how. And secondly, it wasn't mine, it was his. I mean, we've done a few tweaks to it, little tweaks, but nothing special. Plus, I've published it in my book, read my FT columns. I've published it in those. So there's nothing secretive about it. Now, Bill said this, if you're waiting to be right 80% of the time, you'll never make it as a trader. Please read that. If you are waiting to be right 80% of the time, none of what I've said to you today is anything original that I've thought of myself, I'm afraid. I am not Sir Isaac Newton. I wish I was some kind of genius who had great original thoughts. I'm not. Okay? And by the way, it's liberating when you realize you're not. If you're waiting to be right 80% of the time, it's what Bill said, you'll never make it as a trader. So imagine he's your mentor. You go see him. He's super stupidly rich, global head of Forex trading, because that's what I do, aren't you? And he tells you that and you think, shit, I didn't know. Okay, tell me more. And that's what our trading strategies are about. He said, we're not gambling in front of news. Do you think he's paid to gamble in front of news? Okay, he's not into the forecasting business. They were just following trends. Okay, which is why sometimes you get forecasters flummoxed by oil prices. Bloody hell, if the forecasters who do it for a living are flummoxed, what makes you guys think you're not going to be? So we're not going to try and guess it. Now, I know why you're all here. You're all here because of these numbers, okay? The numbers you see here, profit recorded by top. And I don't know SpreadX is not an advert for them. I don't know them. I don't know if they can be trusted or not. I don't know them. When we were publishing one of our books, because we like to research what private investors are doing, ever since the days that I was a private investor back in the early 2000s, late 1990s, this data came from 2012. And you're all here because of this. These are great numbers. It's like the lottery winners. Oh, somebody won 20 million. Does that mean you're going to win it? No, it doesn't. It's great advertising, right? Let's say what we're going to go for. Forget the big numbers we all see with, oh, I'm going to fill the lottery because somebody else won it. What the hell? Okay. No, we're going to try and do 500 a month. It's not guaranteed. Some months it might be more. Some months it might be less or nothing. Okay. But hopefully, if we iron it out, we get some kind of average, right? So we're going to try to do 500 a month. Why 500? Well, because it's usually the difference between rich and poor for most people. Okay, and it means you can start with a sufficiently small amount of capital. We're going to try and do 500 a month because if you can learn the skills to make 500, you can do 1,000. If you can do 1,000, you can do 2. If you can do 2, you can do 4. If you can do 4, you can do 8. Okay, and so on and so forth. So what's the process? Let's work out the process, the business plan, and the entry. These are the most important numbers. I want you to be looking at 12 to 20 products. I'll tell you which ones I like in a moment. 15 minutes a day, one screen, one trade per day, 20 trades per month. I'll show you the business plan, why that's ample. This avoids you having to be in front of the screen too much, or you can do 1 hour on a Friday and just do all 5 trades on a Friday. Actually, no, don't do it on a Friday over the weekend. Do it on a Monday. So we can research it on a Friday, ready for the Monday, okay? So we still need to know the entry. We'll come to that. Now, why do I want you to do it like this? Well, you're going to see in the business plan, this is going to be ample. All right. So I can't sell you a dream about how every trade's going to be right and you're going to be a billionaire in private jet by tomorrow, because that would not be truthful. How will you know it's not truthful? Because you'll just pick up a copy of that and go, Alpesh, hang on. That's contrary to everything that all the rich traders that you interviewed said. What are you telling us? So I've got to tell you the truth, which is what's going to happen is we're going to do it this way. You're going to pick 12 to 20 instruments. Now, the ones we pick will vary, but on the whole, I would suggest, there's nothing wrong with the S&P 500. I like the DAX. It's not on here. What will work will vary at different times. So there'll be times like this where you look at this, the S&P, and it's actually relatively smooth. Can you see that? It's relatively smooth. It's not volatile. It's not jagged going all over the place. Imagine that was a road and you were driving it. Let me look at that. It's something new that I've been telling my apprentices. Imagine that's a road you're driving. You'd think, it's not too bad a road. Okay, it's not going to kill me, right? That's smoothness. It's easier to ride an algorithm when to enter, when to exit based on that than the Himalayas, okay? We want it, relatively straightforward. And you might pick some indices, might pick some currencies. Now, if you're picking currencies, you might not want to, but in case you are, major versus minor currencies is what I'd suggest, or minor versus minor, right? Which are the major currencies? There's only 4: sterling, yen, euro, dollar. Not the ruble, not the Indian rupee, not the Japanese yuan, okay? Contrary to what some people on TikTok are saying about, it's the end of the petrodollar. Seriously, I worry about the future, how stupid people are. Euro, dollar, yen, and sterling. They're the 4 major currencies, all right? I like those 4 major currencies because my political views align with the political systems of those 4 countries. Now, so major versus minor, or minor versus minor currencies, because it's a little bit easier to do them, and so on. Sterling New Zealand dollar recently has been mental. It's just been a lot easier. Now, that won't always happen. And this is a classic example of one which has done really well. So I'm cheating by showing you one. Here's one I made earlier, which is just too perfect. It's not always going to be like this. This is too perfect. This is unrealistically perfect, okay? Where smooth down. Okay, so that won't necessarily last, but I'm just saying what will. Now, if you want to see what we are doing, and I'll give you the free Telegram channel later, oh, no, we don't put it on there anymore. We used to put it on there. Oh, yes, we do sometimes put it on there. We'll put it on there, what we might be looking at, what we are looking at, okay? So there you go. All right, there you go. Okay, we'll sometimes put them there. So I'll give you access to that a bit later on, which ones we particularly are looking at. Now, let's look at the business plan. In closing of the webinar, let's look at the business plan and how do you know when to enter, the strategy, and then we'll do Q&A. Okay, so the business plan, is it all worth it? That's my mum makes an honorable visit in every webinar. So is it all worth it? Is it all worth it? Okay, is it all worth it? No, Deepak, not every 5 years. A lot sooner than that. Okay, how much money can you make? Now, trading, I'm going to give you the analogy of driving. Trading is like driving. When you first learned to drive, you thought there's just too much going on here. There's wing mirrors, rear view mirrors, steering wheel, accelerator, brake, too much going on. But you learned to master it. Similarly with trading, stop losses, entries, take profits, adding to winners, adding to losers. Seems too complicated. Once you get used to it, boom, boom, boom. Okay? And that's what we're going to do. Now, time frames. My favorite time frames, 15 minute, 30, 1 hour. Okay? If you want to go to 4 hour and 1 day, that's fine. It just means you're going to look for longer trends. But on the whole, 30 minute and 1 hour are my 2 favorites. You put a gun to my head. Outside of that, 15 minute and 4 hour are fine as well. But you're just, in a 15-minute bar, the trend is going to be shorter because it's 15 minutes you're looking at. So the trends are going to be shorter. So you're not going to make as much. You're going to trade more frequently. I'm going to show you the maths on which ones work out the best in a second. I'll show you the data on that. Okay. Let me just get this out of the way first. All right. And I like to have a look at what I'd suggest you is have a, by the way, the other reason, great point, David. The reason we say look at different instruments is because look, the yen is not connected to Amazon. All right. So you might be long on one, short on the other. So you're almost hedging basically through diversification. And if you've got a long position on Amazon and you're short Amazon on your trades, you literally are hedging. Okay. That's the one reason. So there's some more sophisticated reasons why we say 20 instruments, right, which are disparate. Obviously, don't pick sterling yen, sterling dollar, sterling Australian dollar. Don't do every single one, which is identical. Okay, so let's say, and this is what Bill said to me. I said to Bill, look, is this any of this actually worth my time? And he said, well, let's do the business plan. So I'm going to take you through the business plan and then the entry point. Okay, the business plan's this. Let's say you're going to lose 1% of your capital. So if the stop loss gets hit, you lose 1%. So if you have 3 consecutive losing trades, you lose 3%. Now, assume not today. You haven't got £20,000 today. Assume you've got £20,000 because you learned the skills and friends, family, or earnings, savings got you to £20,000 because you realize, bloody hell, this is worth it. Okay, so let's assume you got to £20,000 in the future because it's a business plan. A business plan is the future to help you make a decision today whether you want to get on that yellow brick road or not. Okay, so let's say you got 20,000 in there. So now, starting with that, okay, your maximum loss per trade, if the stop loss gets hit, is 1% of 20,000, £200. And win-loss ratio, let's assume for the moment, just for the moment, bear me out and we'll dial it back in a second. You have 60 winning trades out of 100 and 40 are losing trades. So as Bill's working this out for me, I'm like writing it down, going, all right. Average loss, £200, okay. Average win, £300, because winners add to winners, so we'll assume slightly more, not 400, just 300, a little bit more. Okay, and we'll dial it down in a second, so don't worry. And you do 100 trades. Okay, so you've got a good sample. It wasn't like, oh, I made one trade, I got lucky, I'm going to be a trader. No, you did 100. That's a pretty good number. Okay, it's a good sample size, right? Well, 60 of those, based on this, would be winning trades. So I said to Bill, oh my God, £300 times 60, I'd have £18,000 in profits. Now, I didn't grow up with a silver spoon in my mouth. So when he said those numbers to me, I went, oh my God, I want to be a trader. I just want to tell my parents, I want to drop out of university and I want to sit in front of a computer all day long, banging the keyboard, making money, and in my underpants, and that's all I want to do, eating nachos, right? Funnily enough, 20 years later, that's actually how some people do make money. I think it's called OnlyFans. But anyway, 60 times £300 is £18,000. And he said, hang on, calm down, Alpesh. 40 losing trades times 200 is losses of £8,000. And I said, yeah, but Bill, that's still a net profit of £10,000 per 100 trades. That's me set for life. Okay, not with 10,000, but knowing what to do for the rest of my life. So one of the reasons why I left being a barrister. And he said, well, hang on, because he didn't want to make that call to my parents to say, your son's about to drop out of university because I've showed him the green-eyed monster of money. So I said, Bill, I'm going to be a day trader. That's all I want to do. I want to be a day trader. Sit at home, freedom, fulfillment, 100 trades per week. Okay. 50 weeks in a year, because the other 2 weeks I'll be just putting my feet up, getting them massaged by 50 different people. Okay. 5,000 trades per annum is 100 times 50. That means that £10,000 per 100 trades, I'll make £500,000. Bill, this is it. I found it. I found what I want to do. Find what anybody would want to do the rest of their life. Bill said, shut up, Alpesh. Just calm down. And what you should be saying right now is, Alpesh, don't be stupid. We're not going to do 90% of that. We're not going to do 3/4 of that. Numbers look too good. We're not going to do even a 2/3 or a half or a third or a quarter or a fifth of that. We're not even going to do 15% of that, Alpesh. Fine. Any business plan should be toned down. So let's say we did, by some miracle, we did 10% of that. Okay? Okay, let's say we did 10% of that. That's £50,000. Still over-optimistic. Bill said, still over-optimistic, Alpesh. You're not going to do that. You need to give yourself room to learn. You can't just drop off the boat and be rich. He said, keep your day job. Okay? After all, you're going to have a lot of time where you're not trading. Do 100 trades every 6 months or 200 a year, which is, guess what? It's one a day. The markets are open 24 hours a day, 6 days a week. It's basically one a day. Remember, I said earlier on, 1 trade a day is all I want you to do. Not 10 a day. I want you to do 1 a day, right? So keep your day job. Keep doing what you're doing. Don't just take a leap of faith and leave university and say, this is all I'm going to do, right? Keep doing what you're doing. Hedge your bets, basically, by having another occupation while you're learning this, right? And that's what he told me. And instead of 50, well, now we're not toning it to 10%. We're toning it down to about 4%. Well, actually, if you're listening closely, that's too much. 4% of our business plan is too much. Remember I said our business plan is about 500 to, let's say, 1,000 per month. Okay, let's bid it up to 1,000 a month. 1K per month. Well, hang on, 1K per month, okay, is what, 1.8% of our business plan, roughly, something like that, right? That's not too bad. 2.4% is not too bad. If we get 2.4% of our business plan, I think, then we're all right. Well, that's a business plan worth doing. So at this point, you should be asking me, hang on, if those numbers are correct, this is what I said to him. I said, okay, I can keep my day job, learn this, do this. Why isn't everybody rich? Why isn't everybody rich? I asked him, and rightly so. And he said, well, he thinks there's three main reasons. I think he's right. Why isn't everybody rich, other than the fact that they hadn't met Bill? Bad teachers, bad mentors. Mentors and teachers are similar. Mentors are somebody who will be more hands-on than a teacher. Bad strategies. Let's focus on strategies. To close the webinar, how do we know when to enter? I've told about exits, trailing stop. What about entry? 100 trades per 6 months, 200 trades per hour, £20,000. That's my mum again. No, it's not £20,000. It's 1,000 a month. It's not 20,000. It's 1,000 a month, or 500 a month. Actually, it's a demo account, so it's 0 initially. Okay, it's skills learning first. Then it'll go to 500, and then we want it to go to 1,000. Okay, so how does that work out? Well, this is what we're going to do. Let's work out the entry. And I published this in the books and all the rest of it. So I don't even think, oh, he's just made this up now. I've been in this industry for, oh, God, too long. Momentum trading, trend following. Where the guy who's riding the coattails, the guy in purple, the big guys, Goldman Sachs or Winton or AHL or whoever, Aspect, I don't know, one of the big, Brevin House, one of the big houses. We are the little guy in red, losing our hair, but my God, keeping hold of it for dear life. And we're riding the coattails. That's what trend following is. So I said to Bill, how the hell am I going to do that? And he said, well, there's many ways you could do that. He said, one way is measure how close to the high the price closes in that period. I said, why would that work? He said, well, it's a bit like those auctions. Anybody got 40? I'll give me 40. I got 50. Anybody give me 50? I've got 60. Anybody give me 60. It's like those auctions. Momentum, if it closes near the high, then there's an increased probability it's going to close higher. Not a guarantee, increased probability to close higher in the next period. And I said, well, that's all well and good. What am I supposed to do? Sit there with a magnifying glass? And how am I supposed to do this? I don't have, remember I was at university at the time. I don't have complicated, expensive software, and I can't afford it. And I don't want to spend money on it. I want money going in my pocket, not on bloody daily, weekly, monthly fees. Okay. And he said, no, we'll use what's out there, but we'll do it in a way which hedge funds do, which is we won't just look at one measurement or one indicator. We'll look at multiple indicators. We won't just look at the time frame you want to trade, whether it's 30-minute or 1 hour, but the next time frame along, because that then validates where the big money's going in our time frame. So multiple time frames, multiple indicators, and finally we'll look at PC and PR, which I'll come to in a second. I said, well, okay, if we're going to look at multiple indicators, how does that apply to this? He said, well, we want to see not just is the price closing near the high, but has it been making higher highs and higher lows? Those are 3 different indicators. And he said one indicator you might use, but he said it's free and it's out there, so you might want to use it. So I'm giving you stuff which is free. MACD, it just measures this momentum we're talking about, but don't use it the way the textbooks do. So he said hedge funds do 3 things: multiple indicators, multiple time frames, PC, which I'll come to. Multiple indicators. Now you're going to use ones which are already out there, not special bespoke ones. I said, okay. And he goes, you're not going to use it the way they do. So the multiple indicators you can use are MACD, stochastic. Don't use it the way the textbooks do. So I said, well, what does that mean? So what you're going to look at instead, therefore, okay, is you're going to look at this. You're going to look to see, is the MACD, which is a lagging indicator, it's a bit slow. Stochastic's a bit too fast. So what you're going to do is it flat to rising? So that allows for the lag a bit. But you're not going to just look at that. You're going to look at multiple indicators. MACD, stochastic, is it flat to rising and in multiple time frames? I said, why is that filtration important? He goes, well, that's not the most important thing. The most important thing is PC, price confirmation. Has the price made a 2-period high? In other words, has Goldman Sachs put money into it and made that trend happen as well? So multiple indicators, flat to rising, multiple time frames, price confirmation. Multiple indicators, flat to rising, multiple time frames. Now, this becomes very easy then. So initially, I'd have to do this manually. And if you look at free software like this is MT4. It's broker independent. Many brokers offer it. Okay, if you look at free software like this, and I want to show you free stuff that, because retail clients can then use free stuff. Many brokers offer it, so we're not promoting a particular broker. You might say, oh, hang on, I can just drag and drop that, and I can manually see. Okay, that's the MACD, and I can put other indicators across, flat to rising, and multiple timeframes. So not the 15-minute only, but is it also doing that on the 30? You trade the 15, but you have to look at the 30 for confirmation. Why would this work? Well, let me show you why this would work enough to be profitable. It's not about working every time, work enough to be profitable. All right. And this is what the answer was. All right. Triple filtration. That's what I call it. I'm teetotal, but I called it triple filtration. One, it measures momentum to ensure there's a positive buy signal. Multiple time frames, measures momentum. It confirms that momentum across multiple time frames. You'll filter. Okay. And then finally, it qualifies all of that by looking, has it made a 2-period high, whether it's 15-minute bars or not? Now, that is simple enough for a student like me to follow. That's one of my talks at Bloomberg Television Studios. Okay. Or for a retiree, for side gig entrepreneurs. Okay. For full-time plumbers, full-time moms. That's what the audience was. We asked the audience, what do you all do? Right? That was it. Okay, that was it. That was the variety of... Aaron, I'll answer your question at the end because I can't read and answer at the same time. That was simple enough, because remember, it has to be a strategy which is simple enough and allows you to keep your day job, because you want to hedge your bets. You're not going to dive into a new career. So I developed this, like I said, perfected it when I was at university. That's when I met Bill. Red Carnation, last exam. Sorry, I look a bit of a div. Doesn't actually look. I want that hair back. Won competitions in the FT, which helped raise my profile. Why did I want to raise my profile? Well, if you win competitions in the FT and you've got a profile, what's the next thing you can do? You can become like Bill and set up a hedge fund. So that was my plan, and it happened. I went from looking like I did as a student to looking a bit better. Not much, but a little bit better over there. Like I said, won competitions in various places. Merrill Lynch, HSBC, then licensed what I'm talking about, use it themselves. They paid me about, them and a few others like American Express. If you tot up the total, it came to about $1 million. And that $1 million I used to set up the hedge fund. That's me at my first set of offices at Linden Hall. We couldn't afford St. James's or Mayfair, which is you have to be. So we did something sneaky. Well, we could afford it, but I was tight-wadded. I didn't want to spend on office rent. So we got a room in Linden Hall, which is on Regent Street, which is right between St. James's and Mayfair. Now we're in Mayfair because we can be, but I'm paying way too much. We're paying £15,000 a month in rent. You might say, why are you paying rent? Why don't you own the building? Son, you're Indian. I wish I could own buildings in Mayfair. You know, huge office blocks. Are you bloody kidding me? And besides which, I'm not in the property business. Anyway, that's what we did. So I'll let you download it. Just give me a second. Yeah. Don't worry. I can see the questions. I will let you download it. Just give me a second. Give me a second. I'm trying to find my bloody mouse. Here it is. So people then said, why don't you just look? You're writing about this for 20 odd years. You've been writing articles about it. You're giving talks on it whenever asked for Barclays, Merrill's, HSBC, Lloyd's, and you talk about what you learned in your book. Most people talk about their books. And I copied the book writing idea off a couple of billionaires. I like copying billionaires for obvious reasons. So Michael Bloomberg wrote a book. He's a billionaire. And obviously Warren Buffett's written Snowball, which is his book. And I thought, you know what? Writing a book's a good idea because it gives you something to talk about for the rest of your life. And people said, well, wait a minute. Will you teach us? And I said, no, I don't have time for that. I've got a business to run. The business of a CEO of an asset management company is twofold. One is compliance. And two is raising capital. So we launched a private equity fund as well. And then a chap from Barclays Bank came to me called Bikku Aluwalia. Bikku subsequently became my best friend and became my best man at my wedding. And he said, do you know what? You can create a spin-out piece of technology from your hedge fund and we'll float it on the stock market, Alpesh, eventually. We'll get you funding for it. We'll want that deal. I didn't believe him. And I thought, no, that won't work. It was his idea. He said, why don't you spin this out into a separate tech? As a hedge fund, you're buying and selling other people's companies. Why don't you just create your own? You make a hell of a lot more money. And we said, well, and then he pointed out that we've got no competition because nobody else knows what the hell they're doing. And trust me, we've looked at everybody. You can put into the chat boxes anybody you want me to give a view on, and I'll tell you how rubbish they are. Well, I'll tell you why they're rubbish. So we looked at that and we thought, you know what, he might have something. And then he went through the numbers and said, well, it's $1 trillion business you'd be in, the financial markets. Why don't you launch the fintech, the financial technology? And we said, well, what would people want? And I said, I gave him one rule. I don't want to charge people a subscription. I do not want to charge them daily, weekly, monthly, annual fees, because that's what people do when they want to build a business. I said, I don't want to build a business. I want to build value for the end user, and that will take care of benefits to the business. That's the way I want to do it. The Amazon way, I copied Amazon. He said the same. They've been making losses for years. And he said the reason is that's what makes, well, the world's largest company, eventually in his case. And he was the actual manager, was Jeff Bezos. So we did that. We wanted it also to be broker independent, not charge daily, weekly, monthly fees. It shouldn't need constant watching of the markets, as you can see. Should also give access to me. For the first 1,000 charter members, I said, obviously can't be forever, because then when we get more than 1,000 from around the world, we'll have my team. But for the first 1,000 charter members, they'll always have access to me. We've had about 850 who are part of it now. I take them on in groups of 25. We don't charge daily, weekly, monthly fees. We will in future to others when it becomes global as a tech company. We will, but for now we won't. Without an indicator, this is what trading is like. With one, it gets automated. Okay. Biku named it Project Pips. Because in a bank, they need to give it a name. Project Pips Predator. Buy when the price goes above the horizontal line, because it confirms the price momentum. That basically means multiple indicators, multiple time frames, flat to rising, price confirmation. We've thrown in a bit of pattern recognition, which is new, which Bill didn't have because he wouldn't have access to that kind of stuff back then. But a bit of pattern recognition, but you don't need to worry about that so much. And the odds of a profitable move have increased. So we automated it all. We also then, what we did is we took what was free, which is the data and all real time forever and all these instruments. We took all of that, and then we added not just those points, which is, the buy and the sells, but we then, added the text, stop loss, buy there. That's the trade size. If you want to risk, say, £100, that's the stop loss to add more of a position and so on. So it made it even easier for us, because obviously that's what you do. You automate. Okay. Rupin, you are part of the original 1,000. So you've got it for life, all upgrades for life, no subscription fees ever for you. Because I want to get 1,000 on here, then take it to the venture capitalist at a valuation of about $30 million US. You don't need to worry about all of that. That's my problem. Time frames, you asked earlier. We found the 1 hour time frame was the best. I'll show you how to download in a second. Okay. 1 hour time frame was the best. Why was the 1 hour time frame the best? Well, roughly 25 trades in a month, sometimes more, as many as 40, sometimes less, as few as 16-ish. Okay. Net pips captured, 2,250. That's winning minus losing points or pips. Okay. Whether it's CFDs, futures, options, doesn't matter how you place the trade. Okay. 2,250. Now, some months that might be more, it might be 4,000 if the markets are volatile. Okay. Some months it might be 0. Okay. The idea is some months you do better, some months you do worse, and you iron it out like this. You iron it out. Win-loss streak, best. We got 70 heads out of 100. Worse, we got 30 heads out of 100. 30 winning trades out of 100. That doesn't matter. What matters is that number. Now, if you ridiculously did $2 a point, which you should never do, but let's say you did, then in a month, 2 times 2,250 would mean you would have made $4,500. Well, hang on, that's too much risk. We said 500 a month is what we're after. So then we realized you don't need to do $2. This is when we realized it was the Google of trading. You can give it to the mass public. You can do as little as 20 cents or 20 pence. That's not bad, because 20 times 50, which is a typical stop loss, meant you were risking $10 or £10 on a trade. It's not bad for education. Okay. And got to your 500 a month. That was the data we found. And we thought, well, how should we train people up to make them excellent, to make sure that our company was outstanding, that it was better than anything else out there? Well, we asked people what they wanted, and they said, well, we want access to you. We want you to look over our shoulder. So I said, yeah, we can do that through technology, because we've got people from around the world who are clients. Send us your screenshots, but it limits how many we can have joining at any given time, because obviously can't onboard 1,000 people. Business plan, they said, yeah, we'll do a bespoke one for each person. They can practice, send us the trades. We'll show them what we're monitoring and looking at, as I showed you earlier, on a daily basis. We'll show you that. They can sit an exam and get a certificate if they want. This was more appealing to people in their 20s and 30s who were looking for a professional. Their parents wanted their children to get an extra qualification to say, look, taught by an FCA-regulated hedge fund manager. So we take them through a 12-week and a 30-day course. They didn't have to sit it. They didn't have to. They can start it when they want, finish, so that keep it for the rest of their life if they want. But the idea was it was there for those who wanted to go in the industry or those who wanted to really learn. But most people just downloaded the software, read the manual, and just left us alone, we found. We've tracked them, 12-week and 30-day. We benchmark them, and it's for life, and update it for life. We felt this is what makes it different. And we could absorb the losses. The losses on, creating the technology, just like Amazon. We can absorb all of that to build it up, then get it to the VCs, and then fund it, okay? And nobody else had the credentials that we've got. Nobody else had the credentials, okay, at all. So that made it a no-brainer as well. Nobody else had won competition, the FT, and doing fintech, or was a fellow at Oxford doing the research there, or paid by Bloomberg and Financial Times, or a hedge fund manager, or anything else. So we thought, you know what? We've got no competition in this space, and it's a multi-trillion-dollar industry. So can it make money? Well, yes. I'm going to show you how to download it in a second. This is one of my students. It's not me. Full disclosure, it's not me. Euro $1.05. Now they did 5 minute. I don't want them to do 5 minute. They shouldn't do 5 minute. But they sent me this, and 3 hours, 75 pips. Now, why was he doing $30 a pip? Because he built up a body of capital over a period of time where it made sense for him to do $30 a point. It's not that he was stupidly rich to begin with, but it was his risk capital from trading. So that's an important lesson I want to make. That's how you increase size. You don't start off doing like that. You start off with a demo account, you build up the capital, then you increase it gradually. You reinvest it in the business of trading. Or same thing, 9 hours, $2,190, because you've built it up. Who's behind it? Well, this is what it was said in the Financial Times book. It's on the cover. It's printed by somebody who's got a great reputation, chairman of the Chicago Board of Trade, gets to the heart of the matter of trading by clearly elucidating, which I hope I have in this webinar, the methodologies of successful trading strategies. So look, Pat went through, he was the chairman of the Chicago Board of Trade at the time. That bit doesn't matter. This is without an indicator. What's happening? We were trying to get to this. When you can give people JCBs, I think you've got $1 billion business, okay? And we do a couple of other things. To convince you to have it, to try it for us, to keep it for the rest of your life. And like I said, all the data's live, real time. All the updates are free for life. I'm going to give you signed copies of 2 of my books, physical copies, plus a whole bunch of other little goodies. Including USBs, a trading journal, and so on. Now, that's yours to keep, no matter what, okay? Because we want more people to trial this. I take people up in groups of 25. They're with me for life, but in groups of 25, so I can onboard them more easily, because it means a busy week onboarding them. And we want to get to 1,000, like I've said. I'm a bit behind schedule because I've just been busy with a whole bunch of other stuff as well recently. Okay, Khalid, coming up. That's Biku, who's now left Barclays. Thank you, Bix. And those are all the bits. So people ask me, one person asked me, he goes, what is it again? What do I get? The software, the manual, the access to me and my team. We'll install it for you if need be. We mentor you. We show you the trades if you need it. The educational course. My most successful person, her, some might say me, I'm my most successful person. She now manages about 10 billion at Polar Capital. She left university and became my assistant. 25 licenses. There you go, Khalid. Are you ready? It's the next slide. 100% money back guarantee. No quibble. Okay. And like I say, I want to float this on the markets eventually. I think it's going to be $1 billion tech company. That's what it is. And it's a one-off charge. And there's installments as well, because we want to try. When we thought about making it free, the problem we had was when anything's free, people just they just ignore it. And they say, oh, I don't want it. Okay. And then we thought, well, what's a reasonable level? So that's what it is. If you can do it manually, multiple indicators, multiple time frames, flat to rising, like I said, multiple time frames, price confirmation. If you go there, and by the way, this is what I use, before I go on air and know what the price of oil is going to be and and they congratulate me for calling it right and blah, blah, blah. I'm just using this. So I'll let you into a secret. I talk macroeconomics, but actually all I'm using is trend following. But you can't really say that on air. Saying, well, it looks like the trend's going to continue outwards because we just looked at the momentum based on our indicator. Although I have said it. I had an interview with the London Stock Exchange where they interviewed me and I said it there. I want to show you something else as well. So if you go to alpeshpatel.com/, here, you'll see this really ugly page. My team said, the IT guy said, if you want people to take action, you show them a really big yellow box with an arrow pointing at it. Okay. VAT is only applicable if you're in the UK. Okay. If you're in the United Kingdom, VAT is applicable. You can use it on a Mac, David. You can use it on a Mac. If it takes more than 10 minutes to install, we'll do it for you. There is the program. It's all, there's no extra fees ever. Charlene, there's no extra fees ever. Okay. Just so you know, there's no, oh, you're not working. Why don't you do this? Why don't you do that? There's none of the upsells. Okay. Do you get access to the source code? No, it's like Coca-Cola. When you buy Coca-Cola, you can drink the Coke, but you don't get the recipe, or KFC. If you want to buy the source code, happy to negotiate with you what the source code is. I've pretty much described it for you. Multiple indicators, flat to rising, price confirmation, multiple timeframes. Okay, then play around with it. Oh, volatility-based stop loss, volatility-based position sizing. But yeah, Coca-Cola will sell you the source code. Just buy the whole company out. It's a bit more expensive than a can of Coke. Get clear buy and sell signals. Yeah, we use it. See, anything that trends, you can use it on. So you can use it on currencies as well as indices because they trend, as well as crypto. Crypto sometimes is really easy. Sometimes it's really difficult because most of the time it's really straightforward. Okay, because it doesn't have banks trading it, really. There's some hedge funds increasingly now, which is a real pain in the ass because they make things more difficult. Okay. Khalid, yeah, the last one of these I did was 4 months ago, or where are we, March? January, 3 months ago, so probably another 3 months as well. 3 months. If you're waiting for the next batch, if you're waiting for today's batch, it's today. Okay. There we go. So that's down there. We are going to raise prices. You know, I did this and people got shocked because they thought, oh, he's only saying that. He's only saying that. And then we doubled it and they went, oh, shit. A bit like Bitcoin. The more people there are on the program, the less time resource I have. Therefore, the prices go up. Just like Bitcoin. It's the same thing. Which feed would you recommend for crypto? So everything we do is, the reason these feeds are live, real time and free is because we take them off MT4. So I just recommend the feed off that because that's what the algo is going to be sitting on, and that's where the buy and the sell is going to come from. So you might as well have it on the same thing. Now you might have your own software, which is fine. You just sit this aside it. You might have your own broker. It's broker independent. So you place the trade through any broker you want on there. The 12-week course, it doesn't just last 12 weeks. It actually goes on forever. But I called it 12 weeks because that's a reasonable time frame. You don't need to do it. It's more if you really, really, really want to learn even more about becoming a hedge fund manager. We do daily updates on a private channel on Telegram, and there's a public channel there, but there's a private channel where each day I will show, and not all my students are on Telegram. They decide, no, I don't need to be, and that's fine. I'd say only about a third are on Telegram to look at it every day because they just think, no, it's okay, I'm fine, I'm all right, thank you. And it's very structured. Week 1, week 2, week 2, week 3, and so on. And that's if you really want to deep dive, because sometimes people say, I really want to deep dive into this. You know, how can I deep dive into it? And there are installments, Kevin. There are installments because we wanted to cut the price down even more for people. So you just click installments and you can have it in 2 payments if you wish. Okay, as well. The overall ambition I'm going to show you in a second is to have the technology floated. So we've taken the long-term view the way, like I said, Jeff Bezos did, which is, hey, we'll just run it at a, you know, we've got staff, Judy and God, I forgot his bloody name, who did the installation, then Paresh, who co-founded a hedge fund called Marble Bar Asset Management, and he works on the trading side with me. So we've got a team and we just run that at our own cost, and that's fine because we want to build something bigger than that. So there's those bits, and it is no quibble money back guarantee. Those are the countries most of our clients come from. We've got a few outside of that. We've got somebody from, we've got a couple of people from Mexico, got a couple from India and so on. But largely, I'd say that's about 90% of our audience is from the countries represented by those flags. That's 90 of them. Oh, we've got a whole bunch coming through. Ooh. Where's the attendees list? Okay. Good. Thank you. Thanks. No, there's no ongoing fees ever. All upgrades are free. We're on version 4. I was going to launch another version. There'll be no subscription fees for you guys for the first 1,000 charter members, and you'll always have me as the mentor. Going forward, there will be subscription fees. What some of the VCs have suggested, some of you might know my trip to Silicon Valley, Google Ventures, Amazon Ventures, they understand big data. They're looking more at 2,000 a year, if not more, for the software, and 2,000 a year for the mentoring, if not more. What's included? Yeah, I can summarize that. That's not a problem. I've got a whole slide on there. Okay, I'll show you what's included. There you go. So you can download the software. You've got the customer support. You've got step-by-step instructions, the trading manual, videos, the 12-week course, which I just showed you, and it's quite detailed, 12 weeks and 30 days, and that's updated every single week. You've got daily what we're trading, what we're looking at, what signals we're looking at, plus mentoring of you for life. Part of that whole trading club where when I'm meeting up, you can meet up. So I've got an event in the House of Lords, other events coming up, you can meet me. Live webinars every Saturday, 11 o'clock on stop losses, 12 o'clock on limit orders, 1 o'clock on trading, adding to winners, then next hour on money management, the hour after that on trading psychology. So there's loads of ways of getting hold of me: Zoom, email, WhatsApp, Skype, basically, and meeting. I mean, bloody hell, every single thing that you can think of is there, and that shows you the level of what's included, and that's updated. Okay, so that's for life, and there's no ongoing cost. If there's something you think we've missed, let me know in terms of what you think we haven't included that we should have done. Because I think it's pretty much everything. We'll install it for you if it takes more than 10 minutes. Some people, they're not good with computers. They can't find computer folders. We'll just install it for you. Okay, if it takes more than 10 minutes, we'll do it for you. Works on Mac and Apple, absolutely. Mac and PC, absolutely. Follow the signals, trade through any broker you're happy through, and we'll hand-hold you through the whole process. It's not just you download it and then bugger off. We are hand-holding you. We've got a community website as well. We've got a dedicated website, which is for our users. Here we go. We've got a dedicated website for our users, got all the social media links, which has got the 12-week course. And there's a community site where you can post questions, see questions others have asked, and we answer all of those questions for you as well. So there's a whole load of stuff that you see, and how we mentor, how we teach you. Now, some people want no mentoring. They want the software and that's it. Leave us alone. They're on one extreme. The others are like, here's a bunch of my Excel spreadsheet of my trades, and that's fine. And that's good. And then they learn that way, and we go over it and we say, no, that's right. No, that's wrong. And they learn their own, I think, Ravi, if you're on here, they learn their own, as he mentioned me earlier, they learn their own risk appetite. And he said to me, I've learned I'm risk averse, Alpesh. And he's made money for the last 2 months. And I said, good, because the most successful hedge fund managers in the world are risk averse. So that's how you learn. If we just left you with a book or a course or a software, you wouldn't actually learn any of that, because you wouldn't have the feedback. Okay, you wouldn't be taught it on again. You might say, well, wait a minute, if you're spending all this time, you're giving it for life, aren't you making a loss? Yeah, but only for the first 1,000. And that's fine. And only because we can afford to fund it because we've got bigger plans. That's why. So it makes sense for us. Other firms, what they've got to do is they've got to say, no, please use our broker, lose the money quickly, and we've got to charge you for this, that, and everything else, because that's it. They don't have deep pockets, and we want to wipe them out. We want to wipe out the competition. Welcome to capitalism. Okay, we want to wipe out the competition because we don't think they're legit. We don't think they should be in the bit. Thank you. I'm very excited. Oh, by the way, more of you, please go on. How long would you stay on the demo account? Clinton's asked. Until you're consistently profitable. So what does consistently profitable mean? Well, if you're trading each week and it's been 2 months, you might want to toe dip with a live account then. If you're trading very infrequently and it's been 2 months, but you've been profitable in each month, but you've hardly placed a trade because you've not been following the signals, then I'd say you've not been consistently profitable. But what we'll do is we'll judge that on a case by case. So you'd say to us, or you'd give a Zoom call and you'd show us your trades and we'll say, right, I think you're consistently profitable now. It's fine. So it depends. Some students, they'll do it. They'll do 2 trades a day. They'll do it for a month. They're consistently profitable. And they go, you know what, Alpesh, I've got 200 trades or whatever. Got 100 trades. I've got 50 trades. I think I've got enough. And then we'll start. But they'll still start very small because we'll tell them, please make sure you start small. On that. Any other questions? If not, I've got a whole bunch of people. Thank you all very much. Dylan, thank you. Dravid, it's gone through. Dhruv, it's gone through as well. Mo, yours has gone through, and I'm excited for you as well, my friend. Thank you. So you're getting all of this as well. Somebody asked me, didn't they, earlier on, what else do you get? And events, whenever I'm at them, I try and score free tickets for any of my followers and try and get them free into those events so we can meet up, sit down, have a coffee, whatever else it might be. So yeah, the lifetime mentoring and all this. Now we think, by the way, great feedback. Please give me feedback. Is there something we've missed? Is there something we've missed that you think we should have? You know, we give you the daily, we give you the looking over your shoulder. You get to look over mine, Q&A, the cheat sheets, the manuals, everything else. Is there something you think we're not offering that we should? Okay. Let me know if you do. Thank you very much, Khalid. No, don't worry. I will have a look at your Q&A. No problem at all. Did you have to? Oh, sorry, Rob. What was the question? Let me just go down. You said something about Microsoft. Hi, Alpesh. If you get a chance, can you comment on Microsoft? Let me have a proper look at it from the signals and message you back, Rob, because I'll have to pull up the signals on Microsoft because if a new signals come up. So let's have a look at, let me look at this one. Long, and then that actually looked long and then ended up nowhere. So that's probably a slight loss from 2 days ago and then short at the moment. So that's Microsoft at the moment. By the way, what some of the students do, and they won't necessarily use a trailing stop. What some of them do, because they want to be in front of the computer screen all the time, is they'll go long at the green arrows and short at the reds, which is an interesting way of doing it. It's not an official part of the strategy, but quite a few of them have done that because they said, well, look, I'm going to be in front of the computer screen anyway, so I don't mind watching it, they said. Others will use, we actually have red crosses, which show us when the momentum's running out, so you don't have to use a stop loss. There's different ways of exiting based on people's time commitments, so we try to make it as bespoke as possible to suit them on that. That FTSE. Yeah, and this is not to say I'm bearish for the FTSE for the rest of the year, just bearish today. I mean, you know, what can I say? That's what it was. That's what it was. Raymond, you recommend the best FX currency instruments, yet you talked about companies in your examples. How do we determine the best companies? Raymond, it's a brilliant question because it's actually the broader question of trade selection. How do you trade select? And really, it's going to be smoother trends. Now, you might say, what the hell smoother trends? We have not yet created some supercomputer way that we've tried of determining what it's like looking at a road. Okay. Now, if you're Google, you could work out whether a road is smooth or hilly. And that's trade selection. And most times you look at it and you get an idea. But what we do on the private channel is show you the ones that we're focused on, that we think are the smoothest. So that's how it's exactly the same for companies. What's nice and smooth? Microsoft tends to be nice and smooth. Costco tends to be nice and smooth. Basically, the S&P 500 types. Not always. You know, PayPal's one of those. Let me just pull PayPal again. PayPal's one of those little buggers, which, you know, sometimes it's dead easy and sometimes it's a real pain in the ass bugger. You know, it just depends. On, you know, sometimes you can have 3, 4, 5, 6 great trades in an instrument and then it's just useless for the rest of the period. You know, what can you do? PayPal showing all 5 reds at the moment. And you look at it, and at the moment, that went up and then hit our stop loss there, because obviously it went up and then came back down. So we're out and we're flat, and that didn't work out. That was all right. Let's say that didn't anything. That was fantastic. That was fantastic. We're going to get, like I showed you earlier, a load of small wins, a load of small losses, a load of broken hearts where it was in profit. Oh, it's come back now. Okay. And it's going to be the few which do really well. Thank you, Rajesh. Email me. I've got an event. Oh, you're already a member. Oh, yeah. Fantastic. Just email me. You're already a member. We should have met up by now. So email me. You've got my email because you're a member. Who else? Path. Sorry. How do you subscribe? Sorry. I've removed the blooming thing, haven't I? alpeshpatel.com/here. Okay. That's where you subscribe. That's our plan. Let me put it up on the screen. How you subscribe. I'll add a sticky message. Sorry, I removed the thing. If you rush, you'll still get through the door. Just give me a second. I'm going to put it up on the screen. www.alpeshpatel.com/here. And you can subscribe that way. Okay, sorry, I'd removed it off the screen, didn't I? I think. Broadcast comment to the room and then make it sticky. Mark as a tip. And then, I can't remember what else you're supposed to do. Before COVID, I'd had somebody answering all of this and doing it at the same time. Howard, Apple, good. So the question you've got to ask yourself is it an investment or a trade? If it's an investment, I have no issues with Apple. Is it a trade? I'd really have to look at, I have Apple up. I'd really have to look at Apple on a trade basis and determine, is it good or not? This is my Apple. What's at the moment? So all I can tell you, because I had it on screen a second ago. There it goes. That's where we are with Apple. So as a trade, now that started 18th of March that's a 4-hour bar on the 18th of March. So is it good? Long-term investment? Yes, but we're talking about trading. Is it good? Well, at the moment we're long, but look, for all I know, I don't know. Tomorrow we could be out because it depends what happens with the trend. That's trading. Investing, I'm in it for forever, as far as I can tell. But on the trading side, it's that. So is Apple good? That's how you answer the question. Is it a trade or is it an investment? And then depending on which the answer is. On that, any other questions? Oh, I asked if you guys were lucky for me on that S&P 500 trade, because we said we were short the S&P 500. Does anyone know what the S&P is? Okay, were you lucky? The big reveal. Were you lucky for me? Yes, you were. It's gone down a hell of a lot. We're going to add to it down there on the short. Look. You were lucky for me. Well, thank you all. I'll share the profits with each of you. You're all going to do rather well out of this. I'm not going to share my profits with any of you. Okay, right. I better go. I think I've answered all the questions. Sorry, Aaron Singh. Sorry, Alpesh, one more from me. How long is the offer price available? I'm keen to practice a bit more on my own. Some strategies are doing decently, but I like the option parts later. I don't know. We're supposed to be raising the prices in April, not by a lot. Probably not going to be 100% rise, which we did last time. I don't know, Aaron. I got to speak to the guys because they're actually now in charge of that side of things. Leo, yes. Email me, Leo. Khalid said, as you grow, will you continue to mentor one-to-one? Khalid, it's for the first 1,000. So you'd be part of that because we're at 850. I will always be the mentor. For people over 1,000, no, I won't be the mentor because obviously that'll be too many. It'll be Paresh, it'll be others. Might be Judy, might be whoever in the team. Okay. So it'll always be me one-to-one. And that's why we've done it in batches of 25, because we didn't know you could have 850 and still be okay. Because guess what? When people are profitable, they don't bother you. And that's why I've got a built-in incentive to get them to profitability. I've got two. One is so they don't bother me. Let's be honest. If they're profitable, they don't bother me. And secondly is, so then we go to the venture capitalists and say, look, we've got these people who are profitable. Now, 10% give up within the first 30 days. Either they're too busy, trading's not for them. They just say, you know what? I don't know. It's not for me. That's fine. Of the rest, the vast majority, and we've got a whole website of interviews with them as well, alpeshpatelreviews.com. as well are profitable, and our job is to make sure to get them there as quickly as possible, but without rushing them. So yeah, okay, so that's that. Leo, like I said, just message me. Is there anybody else? That's awesome. First time to be with you. Yeah, exactly. Oh, you're in the Q&A section. Sorry about that. This one. Thanks, Alpesh. Hope to have a response from Sajid. Oh, yes. Thanks, David. Absolutely. Keep me posted on that, my friend. Clinton Alpesh, I've joined. We'll see. Yes. What will happen as soon as you join, you're going to get a personal email from me. You'll know it's personal. I'm not bullshitting you, because there'll be a video which will say, hello, Clinton, or hello, Leo, or hello, David. And the reason I do that is so you know it's me doing it personally, because I don't want people to think, oh, yeah, it's all very well on the webinar, but then you bug it off. That's going to be an adding to winner. Now, I've got my team monitoring this, so I know they're going to add to that short. So we've got some profits we're sitting on the S&P 500. Thank you, S&P 500, for falling. Anyway, that's that one. That's where we are with that. And that's our plan. 1,000 pipspredator users worldwide, charter members, venture capital investment, 50 million valuation, most I can get, really. Grow to 10K global base at 4K to 100K. So that's when the prices will go up again beyond what they might get up before then. And that'll be subscription, not for you guys, everyone over 1,000. IPO 4 years, global client base, hopefully reach $1 billion in valuation, because guess what? It disrupts the entire market. Now, it won't just be private investors. There'll be a few institutions. We'll limit the numbers. But yeah, because they're going to pay a hell of a lot more. Have I missed anything? Oh, Khalid. Hi there. Over the last 12 months, IG. Oh, my God. Okay. Yeah, this is it. This is, I can just... No, will you do me a favor, Khalid? Will you email me? Yeah, no, it happens so often. My question is how to best deal with that from a trading psychology perspective. It's better if you email me, Khalid, and I'll give you a reply, a proper reply. What I tend to do with, questions around, your progress and all the rest of it, when it's outside, well, whether it's outside my program or not, I'm happy to answer questions. You're not in the program, that's fine. I'll still answer the question, but I'll do a video recording so you can actually understand. Well, because then I can cover more than just writing. So if you wouldn't mind, thanks a lot. I look forward to meeting you at the House of Lords. Absolutely, Paul. I will see you in Parliament on, I'm going to speak April the 20th. Yes, I saw the email earlier on. Yes. Khalid, yeah, please do email me. And I'll give you as much information as I can on what you should do with that broker and what's been going on. Okay, everybody, I am making a move. I think we're done. I think we are out of spaces anyway, but we're also out of questions, more importantly, which is more important than anything. Don't forget, you can follow me on LinkedIn. Do follow me on LinkedIn. You will see articles and columns and all sorts of interesting stuff from me on LinkedIn. If you're one of my pipspredator signups today, then please join me on the network. Let me know that you are, because you can connect with me on our network. If you're not, then just please follow. And whoops, I will make that smaller. There we go. And you can see all the stuff that I do on there. I think I've got, how many followers have I got on there? Got 15,640. That's how a man's worth is measured nowadays, I'm afraid. 15,000 followers. So do join those 15,000. I've got 60,000 on TikTok. And you'll see a whole load of extra materials and free stuff on there as well. Okay. Thank you all very much. Oh, my pleasure. Thank you. So, yep. Thank you. And like I said, you'll see a whole bunch of stuff on here. And what else can I say? Yeah, that's me. That's me. So if you're not fed up of hearing from me, you can see all of that. Those are just from today. There were like 5 posts today alone. 6. So anyway, okay. Thank you all. That's me at London Stock Exchange with Marguerite. They were interviewing me on algorithmic trading, basically the pipspredator. So London Stock Exchange wanted to know. That's when I looked a bit slimmer. So it was about 2 years ago. And yeah, so that video is on there as well. Okay, thanks everyone. I'm going to make a move now. Appreciate it. And I will, any other messages, just email me and we'll take it from there. Thank you. he says, looking for the, there we go. Bye.